So essentially, this video is going to be about perpetual futures. Now, perpetual futures began as crypto-native workaround to avoid the contract rollover. In the space of roughly 9 months, they have crossed three thresholds at once. In the assets that they wrap, the venues that list them, and the jurisdictions that police them. The product is no longer a sidecar to the spot crypto. It is becoming the always-on layer where price is discovered first and the cash market reacts second. For the allocators, the question is no longer whether the Perps are a niche speculative instrument, but whether the perpetual contract is quietly becoming the dominant price discovery venue for the global macro, and what that does to the dated futures complex and the exchange oligopoly that owns it. When the perpetuals trade above the underlying, longs pay shorts. When it trades below, the flow reverses. That single mechanism replaces the convergence to settlement that disciplines an ordinary future. And it is the reason that the instrument can actually run forever. The numbers that reframe perpetuals as systematic rather than niche are recent. Offshore perpetual volume climbed roughly 28 trillion in annual notional in 2023 and to above 90 trillion in 2025. The top 10 venues alone processed close to 93 trillion last year, a gain of more than 60% year-on-year. More striking is the velocity. Between July of 2025 and February of 2026, the offshore perp volume doubled to around 14 trillion in a 6-month window. And it did so while the total crypto market capitalization fell by nearly 40%. Hello everyone, welcome back to our channel and welcome back to the Capital Insights series. This series sits within our Fundamentals of the Noise series at Punjab Capital Research. And today we wanted to focus on the perpetual wrapper, how always-on leverage is becoming the default venue for global price discovery. So essentially, this video is going to be about perpetual futures. Now, perpetual futures began as crypto-native workaround to avoid the contract rollover. In the space of roughly 9 months, they have crossed three thresholds at once. In the assets that they wrap, the venues that list them, and the jurisdictions that police them. The product is no longer a sidecar to the spot crypto. It is becoming the always-on layer where price is discovered first and the cash market reacts second. For the allocators, the question is no longer whether the Perps are a niche speculative instrument, but whether the perpetual contract is quietly becoming the dominant price discovery venue for the global macro, and what that does to the dated futures complex and the exchange oligopoly that owns it. For our readers, let's first try and understand what a perpetual future actually is. A perpetual future is a derivative with no settlement date. It tracks an underlying price indefinitely, and in place of expiry, it relies on the funding rate, a periodic payment exchange directly between the longs and the shorts, to keep the contract tethered to the spot. When the perpetuals trade above the underlying, longs pay shorts. When it trades below, the flow reverses. That single mechanism replaces the convergence to settlement that disciplines an ordinary future. And it is the reason that the instrument can actually run forever. The design, pioneered by BitMEX in 2016, removes the friction institutional holders know well: rollover. A position in dated futures must be closed and reopened each expiry, and in a market trading above spot, that rollover bleeds value, which is essentially a drag that can compound to low double-digit annual cost on continuously held exposure. Perpetuals eliminate the role entirely. Combined with continuous 24/7 trading and high available leverage, that efficiency is why the structure now accounts for an overwhelming majority of crypto trading activity and the bulk of all crypto derivatives volume. The structural consequence is more important than the convenience. When most turnover happens in a leveraged, never closing contract, short-term prices set by derivatives positioning and spot increasingly follows. With that context, now let's move on to the scale shift, from the sidecar to the center of gravity. The numbers that reframe perpetuals as systematic rather than niche are recent. Offshore perpetual volume climbed roughly 28 trillion in annual notional in 2023 and to above 90 trillion in 2025. The top 10 venues alone processed close to 93 trillion last year, a gain of more than 60% year-on-year. More striking is the velocity. Between July of 2025 and February of 2026, the offshore perp volume doubled to around 14 trillion in a 6-month window. And it did so while the total crypto market capitalization fell by nearly 40%. Activity rose as the underlying shrunk. That divergence is the tell out here. Traders are not accumulating, they are positioning, hedging, and expressing short-term views through leverage. And concentration remains high. Binance still carries close to a third of the centralized perp volume, with OKX and Bybit clustered behind it. Add to that, the offshore venues advertise leverage as high as 125x on the major pairs. But the center of gravity has a structural fragility the headline volume hides. Counterparty risks that the FTX made unforgettable. Opaque insurance funds and the KYC walls that pushed American institutional and retail flow into the VPN access workarounds. The scale is real, so is the supervisory vacuum underneath it. So essentially what we are trying to say is that when the most turnover happens in a leveraged, never closing contract, spot is no longer where the price is made, it is where the price arrives. Next, let's talk about escaping crypto and the real-world asset Perpetual. The generally new vector and the one most underpriced by allocators is that the Perpetual is escaping crypto altogether and becoming a universal wrapper for real-world assets. RWA-linked Perpetuals recorded roughly $525 billion of volume in the first quarter of 2026 alone, comfortably more than $313 billion logged across all of 2025, and the fourth consecutive quarterly increase. Commodities led the expansion: oil, gold, silver, copper, but equities are climbing fast. The single stock in the perp share of the RWA volume rose from rounding error in mid-2025 to mid-single digits by the March of 2026. Now, there are two events that crystallize as to why this matters. Firstly, in March of 2026, a weakened military escalation involving Iran forced traditional crude markets, CME's WTI, sat pinned at Friday's close at nearly $91 to $92 with no mechanism to absorb the shock. However, on-chain, the crude Perpetual ran live, climbing to high 90s towards $115 as the conflict intensified, and for roughly 48 hours, it was the only continuously functioning crude price discovery mechanism on the planet. The second event arrived in mid-May. A pre-IPO Perpetual on the chipmaker Cerebras priced the stock at roughly $340 an hour before its Nasdaq debut and within the 3% of its $350 open, while an accredited-only institutional secondary desk was quoting somewhere around 37% below the eventual print. The lead underwriter is reported to have watched the on-chain quote as a real-time reference. Next, let's talk about the venue migration and the on-chain eating the order book. The second structural shift is where the perps trade. Decentralized Perpetual exchanges have moved from fringe to serious competitors, with the on-chain share of futures volume holding durability above 16%. One venue, that is Hyperliquid, has consolidated roughly 44% of Perpetual DEX volume, up from mid-30s at the start of 2026. And it also runs a fully on-chain order book at sub-second latency that now quotes major pairs competitively with the largest centralized books. Its October 2025 HIP-3 framework let anyone deploy a new Perpetual market permissionlessly, which is precisely what seeded the commodity and equity RWA expansion. Builders and not the central listing committee decide what gets a market. Now, this is a double-edged challenge. It pressures the crypto-native centralized venues on fees and self-custody, but it also routes around the traditional exchange perimeter entirely. A permissionless, always-on, globally accessible listing engine for exposure to the same indices and commodities the incumbents have monetized for decades. Concentration in a single dominant DEX is itself a systemic flag worth tracking. A 44% share is both the efficiency story and the fragility story in just one number. And this brings us to the coming onshore, that is the CFTC moment. Against this backdrop, the United States moved to repatriate the flow. On 29 May 2026, the CFTC, under the chairman who is currently its only confirmed commissioner, approved the first US-listed crypto Perpetual, a Bitcoin contract on the prediction market venue Kalshi, and issued a policy statement opening a path for the registered platforms to self-certify similar contracts and to relist existing dated crypto futures as true Perpetuals. Coinbase was cleared the same day to route US customers to offshore perpetuals through an affiliate. Demand was immediate. Kalshi went live in early June with 13 contracts, cleared 100 million in the first 24 hours and 1 billion inside a week, against a waitlist exceeding 1 million names. The fastest product launch in its history, and it arrived weeks after a 1 billion Series F that valued the company at $22 billion. The incumbents studied it as an existential threat, and the equity market agreed in real time. CME shares fell around 12% after the approval, CBOE 26%, ICE 11%, and Nasdaq 9%. On 18th June, CME filed a suit in federal courts in Washington against the CFTC and its chairman, pointedly not naming Kalshi or Coinbase on 2 tracks. The substantive claim is that the Perpetual's funding rate exchange between 2 parties makes it a swap under the Dodd-Frank and not a future, a classification the agency itself had taken in enforcement actions since 2020. CME essentially is not merely defending its market share. Through its exclusive benchmark licenses, a swap reclassification would force rival products back to CME's own rails, an attempt to own the layer beneath every competitor. And let's wrap up this video with a focus on the fragility underneath. Now, the risk that the allocator's underweight is not a leverage per se, but its interaction with auto-liquidation. Unlike a margin call wherein a broker requests collateral before acting, a perpetual position is engineered to liquidate automatically once maintenance margin is breached to protect the venue's reserves. In a sharp move, the mechanism becomes pro-cyclical, forced liquidations beget price moves that trigger further liquidations. The October 2025 tariff shock, a surprise 100% China tariff announcement, wiped out more than 19 billion of leveraged positions in a single cascade. Funding rates add a second channel. When positioning is one-sided, the funding cost of holding can itself force capitulation. And this is where the onshore debate genuinely bites. Skeptics argue that if 24/7 trading is viewed as volatility amplifier in ordinary futures, the case against perpetuals on the same underlyings is the strongest still. The CFTC's counter is that extreme leverage is a feature of offshore venues, not of the contract structure itself. A regulated US perpetual can be capped near the leverage of conventional futures, as Kalshi's roughly 6 times ceiling suggests. Now, both the things can be true. The unresolved question for now is whether bringing Perps onshore reduces the systematic fragility or it merely relocates it inside a regulated perimeter, while the offshore and the on-chain venues, where the real leverage actually lives, keep setting the marginal price. Now, that's all that we wanted to share with you with respect to perpetual futures and the recent updates. Stay tuned in for more.